Historical simulations and advanced VR measures. Historical simulation VR concept. Historical simulation VAR estimates potential losses using actual historical market returns instead of assuming a probability distribution. It assumes that past price movement will repeat in the future. Today we will discuss about losses, different types of losses. Its objective are define loss control, describe the various types of loss control, derive the optimal amount of loss control using information on the cost and benefits, and last discuss the rationale for government safety programs. These are the objectives. Type of loss controls. Loss control refers to efforts that reduce expected losses. For example, person who drive slowly and cautiously reduce their expected accident losses, because loss control usually involves investments of resources, funds, efforts, or time. These are three major elements. Finding the optimal level of loss control requires considerations of both the benefits, lower expected losses, and the cost of additional loss control activities. An important dimension of this problem is the identification and assessment of the types of amount of losses that particular activities can produce. We begin this session by illustrating the different type of loss control with individual and business examples. This discussion also highlights that loss control decisions involves trade-offs, sometimes difficult, between the benefits of loss control and the cost of loss control. That expected losses can be calculated by multiplying the frequency of losses times the severity of losses. Consequently, a useful way of categorizing loss control activities is to distinguish activities that alter the frequency of losses from those that alter the severity of losses. Of course, some activities influence both the frequency and severity of losses. Loss preventions. We should be able to prevent all the losses in our organizations. Numerous activities reduce expected losses by reducing the frequency of losses. Loss prevention. For instance, a family that builds a fence around their yard reduces the probability of their child being hit by a car or drowning in a neighbor's pool. The cost of the loss prevention is the cost of material for the fence, the time spent installing the fence, and any reductions in the beauty of landscaping. The benefit is the reductions in the probability of a child being injured or killed. If families make decision on whether to build a fence based on the cost and benefits, then families with smaller children, families with more income, families with neighbors who have pools, and families that live on busy streets are more likely to build fences. Means, just like in our family, we try to protect our children. Okay, because children are always innocent. They can perform any task which is not expected by us. Loss reductions. Activities that reduce expected losses by decreasing the size of conditions on a loss occurring are called loss reduction. They can occur before or after a loss. Pre-loss activities occur before a loss. They decrease the magnitude of loss if one occurs. For example, investment in firefighting equipment such as fire extinguisher reduce the magnitude of loss from a fire, but this investment does not prevent a fire from occurring. Post-loss activities occur subsequent to an event that causes a loss. For example, placing plywood over windows that were broken in a storm can reduce subsequent water damage and theft losses. Computation steps means calculations. It collects historical data for asset pricing or returns. Calculate daily portfolio returns using current portfolio weights. Arrange returns from worst loss or highest gain. Select the loss corresponding to the required confidence level. Example, if 1000 observations are used and confidence level is 99%, the 10th worst loss represents VAR. When we have given you the project, research project, we have also told you that always take a title on your observations, real observations, and you are really interested to do research on that topic. So you could be able to collect the perfect data from your organizations. Advantages: no assumption of normal distribution, simple and intuitive, captures head, tails, and skewness. Limitations depends heavily on past data, ignores new market conditions, cannot model extreme rare event sales. For this, we will study about analysis tools used in corporate risk management. And our objectives are show how to use historical loss data to calculate the characteristic of probability distribution of future losses. Illustrate how to use regression analysis in risk management problems and how to interpret regression results. Show how to calculate and correlation coefficients. Illustrate how to use Monte Carlo simulations to access the desirability of alternative risk management policies. Show how to calculate incremental cash flows and their present values. Risk management tools. You learn about probabilities distributions and the characteristics of probability distributions, expected values, standard deviations, and correlations. In these sessions, we extend the analysis of by presenting some tools used by corporate risk managers to analyze their risk, the improve decision making. We note at the outset that the tools discussed in these sessions are primarily used by large firms. Generally, it is not worthwhile for small businesses or individuals to spend resources conducting the analysis described in this session. The information generated from the analysis would have little impact on determining how much risk they can reasonably retain. For small businesses and individuals, risk management decision depends largely on judgment, and commonly they are influenced by the advice of insurance agents and brokers. For large firms, the value of information provided by statistical analysis is much more likely to exceed the cost of undertaking the analysis. The cost of data collection, analysis, and interpretation. The information provided as likely to be more meaningful and reliable, and large firms can spread the fixed cost of analysis over a larger number of exposures. Calculating frequency and severity of losses from historical data. A table represents that data on medical payments resulting from workplace accidents at two restaurants owned by Clary corporations. The restaurants are of similar size and design, employee, and same number of people, conduct similar amount of business revenue, and are located in area with similar healthcare cost. The table provides the date of the accident and the amount of the loss for the year 2002. In this particular case, the loss payments are matched to the date of the accident, not when the payments were actually made. Simple linear regressions. Consider the scatter plot depicting data points for the variable x and y using entire probability distributions. In the previous analysis, we focused on the expected values of the frequency and severity of losses. In some situations, analysts would like to know the entire probability distributions for important variables. For example, of property losses, taxable earnings, after tax cash flows. Under alternative risk management policies, for example, to determine the optimal liability property insurance coverage, a risk manager ideally would like to know each possible loss amount during the year and their associated probabilities under alternative policy provisions, deductible and limits. While this ideal is seldom achieved in practice, a variety of approaches can be used as a means to improve decision making. These approaches usually involves approximately the total loss distributions or at least estimating the expected value, standard deviations, and maximum probable loss of total losses or cost. The remainder of this section focuses on two common approaches to estimating loss distributions or key summary measures of these distributions. One is relying on large sample probability distribution theory, that is, assuming that the loss distribution can be appropriated by the normal distributions. And second, using computer simulations. It is very easy to use ERP, MIS softwares to simulate approximately loss distributions with the normal distributions. You learned in these sessions that if losses are independent across exposures, then the probability distribution of the average loss per exposure approaches the normal probability distribution with its familiar bell shape. As the number of exposure increases, this result is known as the central limit theorem. Thus, if a firm has a large number of exposure with zero or very low correlations in losses across exposures, the distribution of its average loss will be approximately normal. The distribution of the total loss for all exposures also will be approximately normal. A nice feature of the normal distribution is that knowledge of the expected value and standard deviation is sufficient to obtain the entire probability distributions. Consequently, if we can find the expected value and standard deviation of total losses, then we know the entire probability distributions for total losses, provided the total loss distribution is normal, which is the same as assuming a large number of uncorrelated exposure units. Fortunately, the expected value and standard deviation of total losses can be calculated. Given information about the expected value and standard deviation of loss per exposure, the expected value of the total loss distribution will equal the number of exposures times the expected loss per exposure. The standard deviation of total losses will equal the square root of the number of exposures times the standard deviation of loss for the each exposure. Another illustration is given to illustrate how the firm might rely on the assumption that losses have the normal distributions. Consider the case of Stallone Steel. Stallone has obtained data on workers' compensation losses for each of its workers for the last 5 years and has adjusted the historical data to current values based on inflation and possible changes in workers' compensation benefits. The sample mean loss per worker, total losses during the sample period, number of workers is 300 and the sample standard deviations is 20,000. Because Talon has 10,000 workers, it is willing to assume that the total losses for the upcoming year will be normally distributed with expected total loss that is 3 lakhs means 10,000 multiplied by 300 and a standard deviation of total losses of 2 lakhs that is 100 into the square root of 10,000 multiplied by 20,000. Using the properties of the normal distributions, Talon can estimate both the probability that losses are less than any given amount during the year and maximum probable loss at any desired level of confidence. For example, there is a 0.95 probability that any normally distributed random variable is less than its expected value plus 1.645 standard deviations. Thus, Stallon's maximum probable loss at the 95% level is approximately 63 lakhs, means 30 lakhs plus 1.645 multiplied by 20 lakhs. Similarly, there is a 0.99 probabilities that any normally distributed random variable is less than its expected value plus 2.33 standard deviation, which implies that Stallon's maximum probable loss at the 99% level is 76 lakh 60,000. That is from 30 lakhs plus 2.33 multiplied by 20 lakhs. While the formulas are too complicated for us to cover here, the expected value and standard deviation of a normally distributed random variable that is truncated at particular points also can be readily calculated using the right formula. This means, for example, that if Stallone decided to purchase excess insurance with a $5 million annual aggregate retention, it could calculate the expected value and standard deviation of retained losses less than the $5 million retention limit, problems and limitations. The principal limitations of assuming that losses are normally distributed is that the assumptions often will be inappropriate in practice. First, the assumption is based on the central limit theorem, which simply describes a tendency as the number of exposure becomes infinitely large unless firms have very large numbers of exposures. The true distributions of total losses will likely exhibit positive skewness, and different from the normal distributions could be substantial compared to the true positively skewed distribution. The normal distribution will tend to understate the probabilities of large losses. We illustrate this result in the next session. As a consequence, the firm will underestimate the likelihood of large potential disruptive losses. This is not the type of mistakes that firms wish to make. Second, in many cases, losses will not be independent across exposures. In the case of worker injuries, for example, many workers might be hurt in a single accident. Positive correlations in the losses across exposures increases the standard deviation of total losses. Again, the result is that the procedure illustrated above will tend to underestimate the probability of large losses. In addition, the central limit theorem assumes independent so that assumption the normal distribution may produce significant errors even if a firm is very large. A third limitations of the procedures illustrated above is that it does not facilitate analysis of the per occurrence deductible and policy limits. The reason is that the procedure provided estimates of the aggregate loss distribution only. It does not provide evidence about the loss distribution for individual losses or occurrences. As a consequences, while the method might help, some firms may take decisions about aggregate annual retention limits without per occurrence deductible. It is not useful in the many cases where firms wish to consider limiting their exposure to losses from a single occurrence. Computer simulations of loss distributions. In many cases, realistic probability distributions for loss frequency and severity cannot be combined mathematically to drive the distribution of total losses. If, however, a firm is willing to estimate or make assumptions concerning the shape of the loss, frequency, and severity distributions. Computer simulation of loss distributions using one of several software packages can be employed to estimate that probability distribution of total losses as well as the effect of per occurrences, deductible, and policy limits. Computer simulation also can be used to obtain this type of information on loss frequency and severity and expected losses. In general, computer simulations of loss distributions often provides a versatile and valuable method of providing insight into the distribution of losses and the effect of alternative risk management strategies. It does not rely on the assumptions that total losses are normally distributed, while more difficult to do accurately, it also is possible to incorporate in the simulation assumptions concerning possible correlation in losses across exposures. Illustration. We illustrate the method of computer simulation for the product liability exposure of Gatewell Pharmaceutical Company based on an analysis of its own data as well as industry data on product liability claims. Gatewell assumes that the frequency of lawsuit by consumers claiming damages for adverse reactions to drug that it has manufactured can be reasonably approximately by a Poisson distributions. This probability distributions often is used to describe accident probabilities. The Poisson distribution assumes that the probability that an event will occur, such as an accident, is constant in any small time period. However, you do not need to worry about the technical details of these distributions. All that you need to recognize is that is distribution often provides a reasonable description of reality and that it gives the probability that there will be zero claims, one claims, two claims, and so on during a given year on other specified time period. When you will finish your MBA course and you will join any organizations, there are so many employees who are also done their MBA degrees and are from different streams. You are belongs to finance. Other may be from other. For example, SCM, supply chain management or marketing, banking, IBM, international banking management, business management, and maybe from other HR and others. What will happen? You have the knowledge of finance, but the other MBA should not have that particular knowledge, just like you. Although they have completed their MBA, but their streams are different. So keep in your mind. Gatewell believes that the expected number of lawsuits during the year is 30, but it also wishes to allow for parameter uncertainty that arises due among other factors to uncertainty associated with legal standards that will be applied to product related injuries. Gatewell decided to allow for this uncertainty by making the assumptions shown in the table. In this way, Gateway builds assumptions about uncertainty in the legal system into the analysis. In effect, it allows for increased risk due to dependence in claim frequency across exposures that can arise from changes in legal standard. Here, one's point is most important assumption and certainty in the legal system into the analysis. Okay, means it has shown in the format of tables. Means if you want to take an analysis on different data, you should have to arrange that data in the form of tables. Okay, in Excel, you can use pivot tables to analyze data or to create a handsome desktop where you can get the overall ideas of your financial institutions in a simple glimpse. Based on analysis of historical data and published research on distributions for the severity of the cost of liability claims, Gatewell assumes that the loss severity will have the long normal distributions. A distribution that is commonly used to describe the severity of property and liability losses for a random variable with a log normal distributions. The natural logarithm of the variable's value has the normal distributions. Thus, the name log normal. The log normal distribution is characterized by positive skewness, as is true for most severity distributions. Gatewell estimates that the expected value of the severity distributions is $1 lakh and that the standard deviation is 3 lakh if desirable. Gatewell also could allow for uncertainty in these parameters, but we assume that you will get the main idea without us going to any more trouble. The loss frequency and severity distributions for Gatewell are illustrated in figure. The first panel shows the claim frequency distributions assuming a Poisson distribution with an expected value of 30. Note that the distribution is bell-shaped for an expected number of losses. This large for lower expected numbers of claims per period such as zero point 0.1, which might describe the frequency of your having an auto accident. The distribution would be highly skewed. Large probability of no loss, increasingly small probabilities for 1 to 3 losses, etc. The second panel shows the sample frequency distribution obtained by randomly drawing 1000 outcomes, that is from 1000 trials of a simulations from a Poisson distribution where the expected value varies according to the assumptions shown in the table, as can be seen. Allowing for uncertainty in the expected value increases the variability of claims frequency compared to the first panel. The third panel shows the sample distribution of 1000 trials from a log normal distributions with expected value equal to $1 lakh and standard deviation equal to $3 lakh. Note that most claims are less than $6 lakhs, but some are much larger. If you have seen the movie Race, in that race movie, it is shown that how claims are passed with implementation of few amendments. Given this assumed distribution, Gatewell can use computer simulation to generate many years of hypothetical losses in order to estimate its probability distributions of losses and the effect of different insurance arrangements. The simulation proceeds as follows for each trial year. 1. In the first step, an expected claim frequency is randomly sampled from the distribution shown in table. This outcome of these steps is either 20, 30, or 40. Second, in the second step, the number of claims is randomly sampled from a Poisson distributions with expected value determined by the first steps. That is, if the first step produces an expected value of 20, then the sampled frequency distribution has an expected value of 20, and so on. The specific value drawn might be 4, 9, 19, 32, and so on. 3. In the third step, a claim severity amount for each claims is randomly sampled from a log normal distributions with expected value $1 lakh and standard deviation of $3 lakh For example, if the second step produces a claim frequency of 35, then 35 claim amount are sampled in the step. The specific severity drawn might range from a very small loss to a loss in the million of dollars. 4. Summing the claim severity sampled in steps 3 yield the total loss for the given trial year. 5. The effects of alternative insurance arrangements on the distribution of retained losses can be estimated using the output of the simulation by applying coverage limits and deductible to the loss amounts generated in steps 3 and 4. For example, with a $5 lakh per occurrence retention, Get will retain the amount of each loss sampled in steps 3 up to maximum of $5 lakh. 6. Repeating step 1 through 5 over trials provides an estimate of the probability distributions of annual total losses and the probability distributions of annual retention losses for any arrangement considered in step 5. We summarize the result of a 1000 trial simulation of Gatewell's loss distribution and its returned losses for the three alternative insurance policies summarized in table. The first policy provides $5 million of coverage pre-occurrence above a $5 lakhs per occurrence retention deductible for a premium of $7 lakh 80,000. Gatewell pays the first $5 lakh of any loss. The insurance pays any amount above $5 lakh up to its limit of $5 million, a total loss of $5.5 million. There is no aggregate annual policy limit. The second policy provides $5 million of coverage per occurrence above $1 million per occurrence retention for a premium of 4 lakh 15,000. Again, with no aggregate annual policy limit. The third policy provides an aggregate annual limit of $10 million in excess of a $6 million aggregate annual retention. There is no per occurrence limit or deductible. Gatewell pays the first $6 million of losses during the year. The insurer pays the next $10 million. Gatewell has to pay any losses above $16 million. The premium is $1,65,000. The simulated distribution of total losses are retained losses for the alternative retentions insurance plans using the simulated distributions. Table shows the mean standard deviations and maximum probable value of retained losses at the 95% level for each alternative. It also shows the maximum value of retained losses, the probability that total losses will exceed the insurance coverage limits, and the probability that retained losses will be less than or equal to $6 million. Since retained losses are only one component of the cost of risk, it shows the mean total cost defined as the mean value of retained losses plus the insurance premium and the maximum probable total cost at the 95% level. Based on the maximum probable total cost at the 95% level and the standard deviations of returned losses. The least risky strategy for get well is the policy with the $5 lakh per occurrence retention, followed in order to increasing risk by the $1 million per occurrence retention policy, the $6 million aggregate annual retention policy, and no insurance. Note, however, that this order does not hold for the maximum value of returned losses obtained in the 1000 trials because more of a very large loss in 1 year was paid by the $10 million aggregate limit policy than by the $5 million per occurrence limit policies. Due to savings on insurance premium, loading from increased retention, the ranking in terms of the mean total cost premium plus mean retained loss is reserved. The $5 lakhs per occurrence retention policy is the most expensive strategy, followed by the $1 million retention policy, the $1 million aggregate annual retention policy, and no insurance. Based on this information, Gatewell can make an informed decision about which strategy to pursue. For example, it can decide whether the additional risk reductions made possible by the $5 lakh per occurrence retentions policy compared to the $6 million aggregate. The premium used in the example equals estimates of the expected value of the insured claim cost obtained from the simulations plus a leading charge equal to 25,000 plus 20% of expected claim cost rounded to the nearest 5,000 because the premium is not random. The standard deviation of the total cost equals the standard deviations of returned losses. Retention policy is worth the additional expected cost of 1 lakh 4,000 means dollar 31 lakhs 94,000 minus 30 lakh 90,000. Comparison of results to assuming the normal distributions. We noted earlier that assuming that losses have the normal distribution can cause a firm to underestimate its maximum probable loss at a given percentage level. If the true loss distribution is positively skewed, as can be seen in figure, the simulated distribution of total losses for Gatewell is positively skewed. Consider that would happen if Gatewell has assumed that total losses had the normal distribution with the expected value and standard deviations equal to the mean and standard deviation for the simulated distribution of total losses shown in the no insurance column of table. The predicted maximum probable total loss at the 95% level, assuming the normal distribution equals dollar 60 lakh 67,000, the mean value of 30 lakh 42,000 plus 1.645 times the standard deviation of 18 lakh 39,000. This amount is 6% lower than dollar 64,000 lakhs 62,000. The simulated value of the maximum probable loss at the 95% level. You also should recall that assuming the Normal distributions for total losses would not allow Gatewell to evaluate the effects of the per occurrence retention and coverage limits. Limitations of computer simulations. Computer simulations can be a valuable tool in guiding decision making to the extent that the reasonable assumptions or estimates of the shape and parameters, for example, the expected value and standard deviations of loss, frequency, and severity distributions can be obtained. The principal limitations of the method arise from parameter uncertainty. At best, the inputs to the simulations are only estimates of the true parameters and distributions. It might be especially difficult to incorporate accurate information about dependence in losses across exposures. Note, however, that parameter uncertainty can be incorporated in the analysis as was illustrated for Gatewell in the case of claim frequency. In addition, different simulations can be run to examine the sensitivity of the results to different assumptions occurring the type and parameter of the assumed frequency and severity distributions. For example, Gatewell might examine the result assuming that claim frequency is described by one of the commonly used alternatives to the Poisson distribution. Correlation analysis. In this session, we discussed correlation between two random variables. Recall that two random variables can be possibly correlated, negatively correlated, or uncorrelated. In these sections, we describe how to calculate correlation, coefficients, and present an application. The correlations coefficient, which is typically denoted by the Greek letter rho, means type of P, probability, between two random variables x and y is defined as the covariance between x and y divided by the product of the standard deviation of x and y. Rho equal to co into xy divided by standard x and standard y. The correlation coefficient is always within the range -1 through 1. A correlation coefficient of -1 indicates perfect negative correlation, that is x and y moves in opposite directions and by equal amounts in units of standard deviations relative to their expected values. For example, if the realization of x is above its expected value by one standard deviation, then y will be below its expected value by one standard deviation. To give a numerical example, suppose that x has an expected value of 5 and standard deviation of 10 and y has an expected value of 6 and standard deviation of 3. Then if correlation coefficient between x and y is -1 and we observe an x value of 15, one standard deviation above its expected value, then y will take on the value of 3, one standard deviations below its expected value. A correlation coefficient of 1 indicates perfect positive correlations, that is x and y move in the same directions and by equal amount relative to their expected values in units of standard deviation. Using the numerical example above, but changing the correlation coefficient to 1, If we observe x taking a value of 15, then we observe y taking a value of 9. A correlation coefficient of 0 indicates that the random variable are uncorrelated. That is, the outcome of one variable law does not provide information about the likely outcome of the other variable. A value of rho between -1 and 0 indicates that the variable are negatively correlated, but not preferably perfect. Negatively correlated variables tends to move in opposite directions, but they do not always move in opposite directions. The closer rho is to -1, the greater the likelihood that the variable will move in opposite directions. A value of rho between 0 and 1 indicates that the variable are positively correlated and therefore tend to move in same direction. Again, the closer rho is to 1, the greater the likelihood that the variable will move together. The typical method of calculating the correlation coefficient between two variables is to gather historical data on each variable and then calculate the sample covariance between the two variables and divide by the sample standard deviation. The sample covariance can be calculated as follows. Sample covariance between x and y equal to summation of x1 minus x bar and y1 minus y bar divided by t minus 1, where t is the number of observations. X and y are observation for x and y during period t. X and y are the sample means of x and y. The sample standard deviation is given by the formula, that is sample standard deviation for x equal to in under root summation uh, under t equal to 1 into x1 minus x bar square divided by t minus 1. One application of correlation coefficient is for accessing basis risk associated with a hedging instruments. This gives data for fuel purchased in barrels, fuel cost, the barrels, the total fuel cost for McMine Trucking Company during a 24-month period, as well as the price of oil on which a future contract is based. McMinn would like to know whether the future contract is likely to provide a good hedge for its fuel cost. McMinn therefore calculates the correlation coefficient between its per barrel fuel cost and the price of oil and the correlation coefficient between its total fuel costs and the price of oil as indicated at the bottom of the table. The correlation between the per barrel fuel cost is 0.95, indicating that the price of oil and mean fuel cost per barrel are highly correlated. However, the correlation between means total fuel cost and the price of oil is only 0.73. The reason for the lower correlation with total fuel cost is because of the variation over time in the amount of fuel purchased by McMinn. Thus, the future contract would have relatively little basis risk with McMinn's per unit fuel cost. but considerable basic risk with MAC means total fuel cost. Other computation risk collects historical data for assets price or returns, calculate daily portfolio returns using current portfolio weights, arrange returns from worst loss to highest gain, select the loss corresponding to the required confidence level. Example, if 1000 observations are used and confidence level is 99%, the 10th worst loss represent VAR. Advantages, no assumptions of normal distribution, simple and intuitive. Capture fat tails and skewness. Limitations depends heavily on last past data, ignores new market condition, cannot model extreme rare events well. Multi-factor where concepts. Multi-factor where measures risk by considering multiple underlying risk factors that influence assets prices instead of a single return factor. Common risk factors, interest rates, exchange rates, equity market indices, common commodity prices, credit spreads. Computation framework, identify relevant risk factors, estimates sensitivity of assets to each factors, factor loading. Third, measure volatility and correlation of risk factors or calculate portfolio variance using factors covariance matrix. 5. Computer we are using this formula. Advantage, better risk decomposition suitable for complex portfolios. Capture systematic risk diverse. Limitations, model complexity, estimations, errors in factor sensitivities. Requires large data sets. Marginal value at risk. MVR concepts. Marginal VR measures the changes in portfolio VR due to small increase in exposure to the particular assets. It answers how much does total portfolio risk change if assets weights increases slightly. Formula is given and uses are to identify risk contributions of individual assets, helps with capital allocation, useful for portfolio optimizations. The marginal value at risk method is the amount of additional risk that is added by a new investment in portfolio. MVR helps funds managers to understand the change in a portfolio due to the subtraction or addition of a particular investment. Relative incremental VAR. Relative VAR, also called incremental VAR, measures the change in portfolio VAR due to a discrete change in the portfolio, such as adding a new assets, increasing, decreasing exposure, changing portfolio weights. Difference between marginal VAR and relative VAR given here. Importance of advanced VR measures improves portfolio risk monitoring, helps in diversification decisions, supports regulatory and internal risk limits, enables better capital efficiency. Marginal VR. Why it matters? Portfolio managers use MVR to identify the best hedge or the riskiest addition. If you are hitting your risk limits, you look for the assets with the highest MVR to sell first. Relative VAR comparison also given here. Thank you. The session is over.